Welcome back to Talk Tickers, the show where we obsess over earnings calls so you don't have to. We are digging into the latest reports to find the signal in the noise.
We certainly are.
Today, we are heading up to the Pacific Northwest to look at Columbia Banking System, ticker symbol COLB. This is their Q4 2025 review.
And honestly, if you thought regional banking was boring, you haven't been paying attention to this one. This wasn't just a quarterly report. It was like a manifesto on integration.
It definitely feels like a pivotal moment. We're calling this the Integration to Earnings Power chapter. It's the first full quarter with Pacific Premier ticker PPBI fully in the mix.
That's right.
But before we get into the weeds of the merger, I want to start with the mystery of the market reaction.
It is a mystery, isn't it?
It really is. I mean, I'm looking at the headline numbers here. They beat earnings expectations. Revenue is up massively year over year. By all traditional metrics, this was a good quarter. And yet, the market gave them the cold shoulder. Stock dropped about 2%.
Yeah.
So my first question for you is simply, why punish a beat?
It's the classic show me penalty. The market is looking at this and saying, okay, the headlines are nice, but the internal plumbing is still messy.
Let's look at the scoreboard first, just to set the baseline. What did the actual numbers look like?
Well, on the surface, it was a victory lap. Operating earnings per share came in at 82 cents.
Okay.
Now, to give you some context, the street consensus, what all the analysts were guessing, was around, 71, 72 cents? So coming in at 82 is a massive beat. We're talking roughly 15% above expectations.
Then revenue.
They brought in about $717 million, which beat the consensus of $696 million, and that's up over 45% year over year.
Wow.
Now, we have to be fair here. That jump is driven heavily by the acquisition. You can't merge with another sizable bank and not see revenue skyrocket. That's just physics.
Right, bigger bank, more revenue. But the profitability metrics look pretty shiny too, didn't they?
They did. Return on average assets was 1.27%. The efficiency ratio, which, measures how much it costs them to make a dollar, was a healthy 57.3%. These are solid numbers.
Okay, so we have an EPS beat, a revenue beat, decent efficiency. This brings us back to the drop. There has to be a catch. I'm seeing notes here about the quality of the earnings. Was there an asterisk on this quarter?
A massive asterisk. And this is really the key to understanding why the stock sold off. The beat was driven, in part, by a temporary turbo boost on their net interest margin.
Let's pause there. Net interest margin, or NIM. We throw that acronym around a lot. For anyone listening who isn't a bank analyst, why does that one metric matter so much?
It's the lifeblood of a bank. It's simply the difference between the interest income a bank earns from lending money out and the interest it pays to depositors to keep their money there. If that margin shrinks, the bank's profitability evaporates.
Okay, so in Q4, their NIM expanded to 4.06%. That sounds good. Why is that a problem?
The problem isn't the number, it's how they got there. That 4.06 included $12 million in what's called premium amortization from acquired time deposits.
That sounds like dense accounting jargon. Premium amortization. What does that actually mean in plain English?
Think of it as a sweetener from the merger deal. When they bought Pacific Premier, they acquired certain deposits that had specific accounting treatments. This amortization essentially acts as a credit that lowers their interest expense on paper. It makes the margin look wider than it naturally would be.
It's like a sugar high.
Exactly. It's a sugar high. And what happens to a sugar high?
It crashes.
It crashes.
Yep.
That $12 million benefit expired on December 31st, 2025. It is gone. It does not repeat in Q1.
So the market sees the 4.06% margin, realizes it was propped up by this one-time accounting magic, and knows it's about to drop.
Exactly. And because that sugar high is gone, management had to guide expectations down for the first quarter of 2026. And if there is one thing Wall Street hates more than bad news, it's a guide down.
That explains the technical reason for the drop. But let's zoom out a bit. Aside from the accounting noise, how is the actual business doing? This merger with Pacific Premier was a huge bet. Is it paying off?
If you strip away the accounting noise and just look at operations, the answer is a pretty resounding yes. Management, specifically CEO Clint Stein and President Tory Kaplan, seem very confident. They are hitting their cost-saving targets aggressively.
I saw they hit $63 million in annualized expense reductions by year-end. Is that good relative to the timeline?
It's excellent. That is about 50% of their total target. To hit the halfway mark this quickly after close suggests they aren't hitting unexpected roadblocks. They are cutting where they said they would cut.
And the goal is $127 million in savings by mid-2026, right?
Correct. But here's the thing about mergers: cost cutting is the easy part. You can always fire people and close branches. The hard part, the part that usually fails, is the revenue side. Are they actually winning new business?
That's what I wanted to ask. Usually during a merger, everyone is distracted. Bankers are worried about their jobs, systems are changing, and clients get annoyed and leave. Are they seeing that?
Surprisingly, no. They were listing off specific wins that, validate the entire logic of the deal. They highlighted cases where the legacy Pacific Premier teams brought in deals that Columbia probably couldn't have handled alone, or vice versa.
Can you give us an example?
Sure. They mentioned a law firm that they brought over. This client brought $22 million in credit lines and $20 million in deposits. That is a very attractive relationship-based client.
That's significant.
And they also landed an environmental remediation company, a client with $200 million in annual revenue. They brought in $10 million in credit and $10 million in deposits.
So these aren't just small mom and pop shops. These are serious commercial clients.
Exactly. And they mentioned a surgery center with $40 million in deposits. This is the bull case in a nutshell. You combine a smaller, nimble bank with a bank that has a larger balance sheet, and suddenly you can hunt bigger game.
It sounds like the revenue synergies aren't just a slide in a pitch deck. They are actually happening.
They are. And they are transferring technology too.
Yep.
They adopted Pacific Premier's API marketplace for the whole combined bank, so the integration engine is humming.
Okay, so operationally, things are good, but there's a massive hurdle coming up that makes me, and I assume the market, very nervous. The systems conversion.
The operational risk event of the year.
It's happening later this quarter, so Q1 2026. Management claims it will be seamless. They say they've done mock conversions. Everything looks green. But why does the market get so twitchy about this?
Because history is littered with banks that mess this up. A systems conversion is basically a heart transplant for a bank. You are moving millions of customer records, balances, transaction histories, everything, from one digital brain to another.
And if it goes wrong?
If it goes wrong, your app crashes. Customers can't see their balances. Debit cards stop working at the grocery store. It's a PR nightmare, and it causes customers to leave in droves. We've seen it happen.
So even though management says we've done this before, the market is sitting on its hands until it actually happens.
Exactly. It creates an overhang. No one wants to buy aggressively right before the transplant surgery. They want to see the patient wake up first.
Let's pivot back to the numbers for a minute. We talked about the margin sugar high wearing off. I want to dig into the trajectory. You mentioned they guided down for Q1. How bad is the drop?
It's significant. They guided net interest margin down to a range of 3.90 to 3.95% for Q1.
That is a steep drop from the 4.06 they just posted.
It is. It's the loss of that $12 million accounting benefit we discussed. Plus, they added some wholesale funding in December.
Wholesale funding.
Basically, more expensive money they borrowed to manage liquidity. That drags the margin down. The guidance implies that Q1 is going to be the bottom, the trough. They expect the margin to dip and then rise sequentially through 2026.
So the narrative is it gets worse before it gets better.
Yes. And telling investors in January that they have to wait until July for the better part is a tough sell.
I noticed something else in the data that might be spooking people. The loan book. It looks flat. Actually, it looks like it's shrinking slightly. In a market that is addicted to growth, isn't that a giant red flag?
Usually, yes. But context is absolutely key here. Total loans ended at $47.8 billion. That's flat to down. But this is intentional.
Intentional. They are trying to shrink.
They are trying to optimize. They are actively letting the transactional portfolio run off.
Transactional. What does a transactional loan look like?
Think of a loan where the borrower has zero loyalty. It's mostly multifamily real estate. The borrower just shops for the absolute lowest rate. They don't keep their deposits at the bank. They don't use other services. They just want cheap money.
So they are low profit, low loyalty customers.
Exactly. About 300 million of these loans exited the bank this quarter alone.
So they are essentially firing their worst customers.
It's a diet. They're shedding the empty calories. They have about 4 billion of these loans repricing over the next 2 years. And their attitude is basically, here's the new market rate. If you want to stay, you pay it. If not, goodbye.
And if the customer leaves?
COLB takes that cash and either lends it to a new, better client at a 6.5% yield, or they use it to pay down their own expensive debt.
So technically the bank gets smaller, but it gets more profitable.
Precisely. It's the shrink to grow strategy. It is very smart long-term capital allocation. But in the short term, the headline loan growth number looks anemic. And algorithms see no growth and just sell the stock.
It requires an investor to look past the headline.
And right now, the market isn't feeling particularly patient.
Well, if the stock is down and the growth is paused, are they at least returning capital to shareholders? I mean, where's all this cash going?
That is the silver lining. Actually, it's more than a lining. It's a pillar supporting the stock price. They are buying back stock aggressively.
How aggressive?
In Q4, they bought back 3.7 million shares. But the guidance for 2026 is the real story. They are targeting buybacks of $150 to $200 million per quarter.
Wait, per quarter?
Yes, per quarter.
It is nearly $800 million annualized. For a bank of this size, that is a massive percentage of the market cap.
It is huge. They also bumped the dividend to 37 cents a share. They have over $600 million in excess capital just sitting there. They are essentially saying, if the market won't value our stock correctly, we will just buy it all ourselves.
That is a very strong signal. It sounds like they're trying to buy their way through this transition period.
They are bridging the gap. They know Q1 and Q2 are going to be noisy. They know the system's conversion is scary, so they are using the buyback to support the stock price until they get to the clean run rate.
And when does that clean run rate arrive?
Q3 2026.
Why Q3?
By Q3, the system's conversion is done. The accounting noise is gone. The $127 million in cost savings is fully locked in, and the margin has rebounded. Q3 is when the bank finally looks like the powerhouse they promised.
But we are in January. Q3 feels like a lifetime away.
And that's the friction. The destination is great, but the journey through Q1 and Q2 is bumpy.
Before we get to our next segment, I want to touch on one more risk factor, the macro picture. How is the credit quality here?
There is definitely sector-wide anxiety. We're seeing credit normalization.
Which is a polite way of saying people are defaulting.
Or at least falling behind. For COLB, the headline metrics are stable, non-performing assets are flat. But there was a shift in the internal grading. About $130 million in loans moved from special mention to substandard.
Substandard certainly doesn't sound good.
It's not great. It's a regulatory classification. It means the bank sees a well-defined weakness that could jeopardize repayment. Management said it just reflects an elongated downturn. Borrowers aren't failing, they're just not recovering as fast as expected.
But any migration towards substandard makes investors nervous.
It raises an eyebrow. It's not a crisis, but it's a yellow flag. If that number keeps growing, the buyback won't be enough to save the stock.
One small corporate note I saw. Clint Stein, the CEO, added chair to his title.
Yeah, he's consolidating leadership. Doesn't signal a strategic change, but signals that during this heavy integration phase, there is one captain of the ship. This is purely an execution story now.
Okay, let's pull this all together. We have a bank with strong underlying metrics, a massive buyback, but a messy Q1 coming up with accounting quirks and a scary tech conversion.
That sums it up. It's a messy middle.
Then it is time for our favorite segment. The part of the deep dive where we stop being analysts and start thinking like traders. It is time for This Is Not Financial Advice.
Standard disclaimer applies. We are just two voices in your headphones. We are not your financial advisors. Do your own diligence. Don't blame us if you lose your shirt.
But if you are a hedge fund analyst pitching a wild trade to your investment committee based on this call, what's the pitch?
I call this trade the Q1 head fake.
I love it. Walk me through the head fake.
Okay, the setup is this. The market is absolutely terrified of Q1. We know the NIM is guiding down to 3.9. We know the systems conversion is happening. The stock is already pricing in a stumble. It's defensive.
So everyone is bracing for impact in February and March.
Right. So leg one of the trade, you wait, you sit on your hands, you let the Q1 kitchen sink quarter happen.
You let the bad news hit.
Exactly. The margin drops, the algorithms see growth contraction and sell. The headlines say margin compresses. You let the fear wash over the stock probably dips further. You aggressively accumulate before the Q2 print. You buy the dip in that messy window between, say, February and May.
Why that specific window? Why not wait until Q3?
Because you are front-running the bank's own treasury department. Remember that buyback number?
$200 million per quarter.
Exactly. They are going to be in the market buying huge amounts of stock. By Q3, the cost savings are fully locked, the messy accounting falls off, the margin rebounds over 4%. The shrink-to-grow strategy starts showing higher profitability.
So you are buying the messy middle to ride the clean run rate rocket ship in August.
It's an arbitrage on investor impatience. You're betting that the market can't see past the fog of Q1. You are buying the valley because the map says there is a mountain on the other side.
It's smart. You're essentially using the predictable accounting drop in Q1 as your entry point.
Correct. The bad news is scheduled. We know it's coming. That reduces the uncertainty.
What is the risk? How does this blow up?
The risk is the system's conversion. If they botch the tech migration in Q1, if the app stays down for a week, or if they lose data, then the stock doesn't bounce back. It becomes a falling knife.
Or if that credit migration gets worse, if substandard turns into default.
Exactly. If credit cracks, the buyback won't matter. So it's high risk, high reward. But the setup is cleaner than most.
So, final takeaway on Columbia banking system.
Don't get distracted by the headline beat or the immediate stock drop. This is an execution story. Watch the Q1 margin floor. It needs to hold that 3.9% level. And watch for news on the system's conversion. No news is good news there.
The Pacific Premier deal completes the map, but that clean expense run rate is the holy grail we are all chasing. Until Q3 2026, expect some turbulence.
And remember, volatility is just the price of admission for the eventual payout.
Thanks for listening to Talk Tickers. Don't trade on headlines, trade on the footnotes. We'll see you next earnings season.
Goodbye, everyone.